Hello, everyone, and welcome back to another episode of Facts Matter. We recently just went over part one of the One Big Beautiful Bill. This is part two. In part one, we showed you what the Big Beautiful Bill changes for your wallet, the tax cuts, the new deductions, and the benefit changes. In part two, we show you who pays and how. Because 4.5 trillion in tax cuts does not come from thin air. Three questions. How is it being paid for? What got cut to get there? And what happens to the national debt when the math doesn't add up? Same rules as last time. No spin, no blame, just the numbers. Let's go. Here's the full ledger in one picture. On one side, the law delivers about 5.9 trillion in tax cuts and new spending over the next decade. Think of that as the gross price tag. Everything the law gives out in lower taxes and higher spending. On the other side, it offsets about 2.5 trillion of that through spending cuts and some new revenue. The difference, 3.4 trillion, goes on a national credit card. That's extra borrowing on top of the deficits we already had before this law. And in the interest on that new borrowing, the total cost is about 4.1 trillion added to the national debt over 10 years. That's the CBO number. Nonpartisan, no opinion, just arithmetic. What this means for you? When you hear the price tag, remember there are really three numbers: what it gives, what it cuts, and what it borrows. Now let's break down all three. The 5.9 trillion breaks down into four buckets. The biggest, about 3.9 trillion, goes to permanently extending the 2017 individual tax cuts. That's the piece we talked about in part one, the rates, the standard deduction, the brackets. Without this, your taxes were going up. About 1.1 trillion goes to business tax breaks. Things like full expensing of equipment, the research and development deduction, and the higher pass-through deduction. Over 500 billion goes to new spending, 150 billion for defense, 132 billion for immigration enforcement and border security, and the rest spread across agriculture, Coast Guard, air traffic control, and other programs. And the remaining 400 billion or so covers the new individual tax provisions. No tax, no tips, no tax on overtime, the senior deduction, the SALT increase, and others. What this means for you: if you're a wage earner, most of your benefit comes from that big 3.9 trillion bucket that stops your taxes from rising. If you're a business owner or investor, a lot of your benefit sits in the 1.1 trillion business bucket. The headline provisions, tips, overtime, seniors, are a smaller piece of the total pie. Now the other side of the ledger, where does the 2.5 trillion in offsets come from? The single largest offset, about 1.1 trillion, comes from healthcare. That includes the Medicaid changes we covered in part one, the provider tax reforms, and the decision not to extend the enhanced ACA premium subsidies. About 540 billion comes from phasing out and restricting clean energy tax credits that were enacted under the Inflation Reduction Act. If you installed solar panels or bought an EV using those credits, those incentives are being wound down after 2025. Student loan reforms save about 284 billion through new borrowing caps of 100,000 for undergraduates, 200,000 for professional degrees, and changes to repayment terms. The SNAP changes. The food assistance cuts and work requirements account for about 187 billion, and the remaining roughly 350 billion comes from a mix of other provisions, spectrum auctions, the 1% tax on remittance transfers sent abroad, and other adjustments. Notice something though. Although all of these offsets come from taking away or trimming benefits, not from raising new broad-based taxes. What this means for you. Whether these affect you depends on your situation, healthcare coverage, energy investments, student loans, or food assistance. The offsets are real savings, but they come from specific groups of people, not from everyone equally. While the bill cuts spending in some areas, it increases spending in others. Total new spending about 368 billion over 10 years. Defense gets the largest share, 150 billion, focused on shipbuilding, air and missile defense, and the munitions industry base. Immigration enforcement gets 132 billion. And here's a predict reveal. By how much does ICE funding increase under this law? The answer, from about 10 billion to over 100 billion by 2029. That makes ICE the single most funded federal law enforcement agency in the country. The remaining 86 billion goes to agriculture programs, the Coast Guard, and air traffic control. What this means for you. Whether you see this as necessary investment or overspending, it's helpful to know that a significant slice of the bill's new spending goes to defense and enforcement, not to programs most households use every day. These increases are funded by the same borrowing that adds to the national debt. Let's do the math. 5.9 trillion in tax cuts and spending minus 2.5 trillion in offsets. That leaves a 3.4 trillion increase in a primary deficit over 10 years. But borrowing 3.4 trillion isn't free. The interest on that new debt alone adds another 718 billion before we even talk about interest on the debt we already had. Total impact on the national debt about 4.1 trillion. And remember, several of the tax cuts are temporary. They're set to expire in 2028 or 2029. If Congress extends them like it just did with the 2017 taxes, the total cost jumps to over 5.5 trillion. What this means for you, the law as written adds 4.1 trillion to the debt. If Congress extends the temporary breaks again, the true cost could be 5.5 trillion or more. Future taxpayers, including you and your kids, inherit that tab, either through higher taxes, lower spending, or both. Here's where it gets real though. Right now, the national debt is about 100% of GDP, roughly 30 trillion. Before this law, CBO projected debt would hit 117% of GDP by 2034. That was already historically high. With this law, debt is now projected to reach 127% of GDP by 2034. If the temporary provisions are made permanent, 129%. Here's your predict reveal. When was the last time U.S. debt was this high relative to the economy? We've never been this high outside of a world war. The previous record was 106% of GDP set in 1946, right after World War II. CBO now projects we'll break that record by 2028, just 2 years from now. What this means for you. Higher national debt means higher interest payments. By 2034, interest on the debt alone is projected to cost around 1.8 trillion per year. That's money that can't go to roads, schools, defense, or tax cuts. It just services past borrowing. The slide might be the most important one in its entire two-part series. In 2024, the federal government paid about $900 billion in interest on the national debt. Under current projections, with this law, that number doubles to 1.8 trillion by 2034. To put this in context, by 2034, the interest payment alone will be larger than what we spend on defense, Medicaid, and SNAP combined. Think of it like paying the minimum on a giant credit card bill. You're spending a fortune every month, but nothing in your life actually improves because of it. And if interest rates stay elevated, which is a real possibility, the number could climb past 2.1 trillion. What this means for you. Interest on the debt is now the fastest growing item in the federal budget. It crowds out everything else. Every dollar spent on interest is a dollar that can't go toward services, infrastructure, or tax relief. This isn't a political opinion, it's a math problem that affects every future budget decision. One more thing worth understanding about how this law is structured. The costs are front loaded, meaning most of the extra red ink hits in the first 4 years right now. Nearly three-quarters of the primary deficit impact lands between now and 2029. The savings are backloaded. They phase in over time, mostly in the latter years of the decade. And several of the most popular provisions, no tax on tips, no tax on overtime, the senior deduction, the higher child credit, are set to expire in 2028, 2029. Here's a pattern. The 2017 tax cuts were also set to expire. Congress just extended them in this very law. If the same thing happens with the 2025 temporary provisions, the cost increases by another 1.3 trillion or more. What this means for you, the official 10-year cost assumes Congress has the discipline to let popular provisions expire right when the savings are supposed to kick in. History suggests that's a generous assumption. Now let's pull both parts together. This law does three things at once. It delivers tax cuts and deductions that benefit most households, especially through the standard deduction, the rate extensions, and the temporary provisions like tips, overtime, and the senior deduction. It cuts spending on healthcare, food assistance, energy credits, and student loans affecting the households that depend on those programs. And it adds 4.1 trillion to the national debt, with interest payments projected to reach 1.8 trillion per year by 2034. Same law, three different stories depending on where you sit. If you're a middle income household with employer coverage and no reliance on Medicare or SNAP, you probably come out ahead by a modest amount each year. If you rely heavily on programs like Medicaid, SNAP, or ACA subsidies, the cuts may outweigh your tax savings. And regardless of income, everyone shares the long-term cost of the extra 4.1 trillion in debt. In part one, we gave you three personal action items. Know where you sit, claim what you owe, and protect your coverage. Today, we're giving you something that lasts longer than any single law. Three questions you can ask about any major piece of legislation, not just this one. Question one, who benefits? Don't just read the headline. Look at the distribution of data. CBO publishes this for major bills. Find your income range. See who gains and who loses. If a bill is sold as for middle class, but most of the gains are at the top or bottom, that's useful to know. Question two, who pays? Every tax cut is funded by something. Spending cuts, new fees, or borrowing. Follow the offsets. See which programs get reduced and who depends on them. Question 3. What's the long-term cost? Check whether provisions are temporary or permanent. Ask whether the temporary ones are realistically going to expire or whether they're likely to be extended in the next must-pass bill. The 2017 cuts just went through that exact cycle. These 3 questions cut through the noise on any bill from any party in any era. If you can answer them, you're more informed than most people in Washington. The One Big Beautiful Bill Act is 1,200 pages. Over 2 episodes, we gave you both sides of the ledger, what changed for your wallet and where the money goes. You now have the numbers to decide for yourself. This helps me, this doesn't help me, or now I see where the money is going. That's all Facts Matter ever asks you to do. Look at the data, think for yourself, make informed decisions. If this series helped you, subscribe and share it with someone who wants the facts without spin. Thank you for watching. Thank you for listening. Take care out there. Be safe, and we'll talk to you soon. Bye bye now.